Okay, so let's orient ourselves. It is February 4th, 2026. We're looking at a company that's been around since, what, 1843?
I mean, think about that. They were making bolts before the Civil War. It's incredible.
They literally helped build the modern world. But, today we aren't just talking about power drills and tape measures. We're looking at Stanley Black Decker as this massive barometer for the global economy.
It really is. For the housing market, for consumer confidence, it's a fascinating moment to look at them.
Absolutely. And when we do these deep dives, we're always looking for that signal in the noise.
Right. We want to know where the economy is actually going, not just where the pundits say it's going. And Stanley Black Decker SWK on the ticker, they are that signal. They touch everything.
They're in the DIR's garage and on the high-tech assembly line.
Exactly. The person fixing a deck on a Saturday and the aerospace engineer fastening a wing on a jet.
So the mission for today is, well, it's pretty specific. We've got the Q4 2025 earnings report, the transcript from the call with the CEO, Chris Nelson, and CFO, Pat Hallinan, and their slide deck.
Whole stack of material.
Now, we're trying to figure out how a legacy industrial giant navigates what they keep calling a dynamic economic storm, because looking at the top-line numbers, I'm seeing a contradiction right off the bat that I can't quite wrap my head around.
That's the first thing that catches your eye, isn't it? The headline numbers just don't seem to tell a consistent story.
Right. So let's start with revenue. It came in at $3.68 billion. Wall Street was expecting $3.78 billion. So that's a miss.
A clear miss. They sold less stuff.
They sold less stuff than people thought they would. But then you look at the profit, the earnings per share, the EPS, they beat estimates pretty significantly. It came in at $1.41 per share versus an expected $1.27.
Yeah, that's a big beat on the bottom line.
So help me with the math here. You're selling less, bringing in less money than expected, but you're making way more profit per share than predicted. How do you pull that off?
It really sets up the central mystery of this whole deep dive. How do you win by shrinking? And the answer is in this very deliberate and I'd say pretty painful strategy they executed. It's a classic case of price over volume.
Price over volume, it sounds simple, but that feels like a dangerous game. You charge too much, you just lose the customer.
Oh, it's incredibly dangerous. It's a high wire act. If you look at the core dynamic in Q4, their prices went up 4%.
Okay, that's significant.
It is. But their volume, the actual number of units they sold, that dropped by 7%. And this wasn't an accident. This was their response to what the company calls unprecedented tariff rate increases that peaked back in April of 2025.
Oh, right, the tariffs. That word is all over the transcript. This wasn't just some minor fee. This was a shock to their system.
A massive shock.
Yeah.
And the management team had a choice. They could either, eat the cost to keep prices low and keep moving units.
Or pass it on.
Or pass it on. They made a calculated decision. We are going to protect our profit margins, even if it means we sell fewer drills. They chose profitability over popularity.
But there has to be a ceiling on that, right? I mean, eventually the consumer just says, nope, not paying that. My old drill works just fine.
And that is exactly what happened. This CFO, Pat Hallinan, he talked about this. He said the elasticity was higher than they historically expected.
Okay, let's pause on that. Elasticity. What does that actually look like in the hardware aisle?
Yeah, so think of demand like a rubber band. If it's inelastic, you can pull on the price, raise it up, and demand doesn't really change. Like medicine.
You have to buy it.
You have to buy it. But if it's elastic, when you pull on that price, demand stretches and just snaps back. People walk away. And they found that consumers didn't just grumble, they stopped buying. But it wasn't across the board. It happened specifically in what they call opening price point products.
Opening price point. Is that just corporate speak for the cheap stuff?
Essentially, yeah. It's your entry-level tier. The Black Plus Decker toaster, the starter drill kit you buy for your first apartment, that's where the volume just fell off a cliff. The weekend warrior, the casual DIYer, they pulled back hard.
That makes perfect sense. If you're just hanging one picture frame, you're not going to buy a new drill if the price jumped 10%. You'll just borrow one.
Exactly. Or you'll wait for a big sale. But the whole business didn't tank. And this is where the story gets really nuanced. It shows you the divide in the economy right now.
Okay.
If you look at their tools and outdoor segment, organic revenue was down 4%. That's that consumer weakness we just talked about.
Right. The DIYer is tired.
But there's a bright spot that tells a completely different story.
The other side of the house. The engineered fastening.
Engineered fastening. Sounds a bit boring, but it's critical. This segment was up 8% organically. And if you look under the hood, Aerospace was up 35%.
Wait, 35%? That is massive growth.
It's huge. Automotive was up mid-single digits, too. So what does this tell us? The pro and the industrial markets are holding up just fine. People building planes and cars are still buying.
It's the consumer, the household budget that's cracking.
Precisely. So you have a tale of two economies inside one company. The industrial engine is roaring, but the consumer is tapping the brakes. And this brings us to their whole operational excellence pillar.
Yeah, I saw they mentioned a global cost reduction program. I feel like every company has one of those. Is this just, trimming the fat, or is it something more?
No, this is surprisingly substantial, and it's completed. Since mid-2022, they've achieved $2.1 billion in run rate pre-tax savings.
2.1 billion. Okay, that's not just cutting back on office supplies. That's a massive number.
No, that is structural change. That is cost taken permanently out of the system. And they're not stopping. They're now targeting annual productivity savings of about 3% of their net spend forever.
Wow. And beyond just cutting costs, I was reading about this huge shift in where they get their stuff from. It seems like they're redrawing their whole supply chain map.
This is one of the most significant pivots in the whole report.
Mm-hmm.
The CEO, Chris Nelson, was very clear about it. They're executing a China pivot.
What does that look like? Because I assume most of my toolbox says made in China.
Historically, yes.
Yeah.
A huge chunk of the tools sold in the U.S. were made in China, which is what exposed them to the tariffs. Now, they are moving production for U.S. goods out of China. Their goal is less than 5% of U.S. volume imported from China by the end of 2026.
Less than 5% by the end of this year. That seems incredibly fast for a company this big.
It's aggressive.
Yeah.
And it shows you how urgent this is for them. They're moving it to the USMCA region, the U.S., Mexico, and Canada. They're nearshoring.
Bringing the factories closer to home?
Exactly. It's risk management. By producing in Mexico, they avoid the tariff shock. They stabilize margins. And it stops their inventory from being stuck on a boat for weeks.
That flexibility probably explains their free cash flow number, which is huge, $883 million in Q4.
Right. They're finally getting their inventory levels back to, as they say, pre-pandemic norms. They're not hoarding stuff anymore. They're generating cash. And that cash is letting them make some really big moves.
This was the aha moment for me. They're not just cutting costs, they are changing what they actually sell.
Slimming down to scale up. There are two major divestitures. The first is selling the CAM Business Consolidated Aerospace Manufacturing.
Wait, hold on. You just told me aerospace was up 35%. It's their best performing sector. Why would you sell your prize horse?
It does seem counterintuitive, doesn't it? Sell your winners. But you have to look at the balance sheet. They're selling it for about $1.8 billion.
And the reason is?
To pay down debt. It's all about financial freedom. Their goal is to get their leverage ratio, their debt to EBITDA, to below 2.5 times.
So it's like paying off your mortgage.
Exactly. They had too much debt. This massive lump sum of cash wipes out a chunk of their loans. It buys them flexibility. It's a defensive move that sets them up for future offense.
Okay, that makes sense. Sell the high-value asset to fix the foundation. And then there's the second move, the gas lawnmowers.
The gas exit. This is fascinating. Starting mid-2026, they are transitioning their gas-powered walk-behind mowers to a licensing model.
So if I go buy a Craftsman gas mow in 2027, Stanley Black Decker didn't actually make it.
Correct. Someone else will make it and just pay them a fee to slap the Craftsman name on it. Now, this will hit their revenue, about $120 to $140 million hit in 2026, but
they were low-margin products.
Exactly. They're heavy, they're expensive to ship, engines break, oil leaks, and they're increasingly unpopular compared to electric.
So they're betting the farm that the future of outdoor work is battery-powered.
Completely. They're clearing the deck of the old techs to focus on their electric lineup. It's a classic shrink-to-grow move.
Speaking of modern, let's talk about the tools themselves. Because for all this talk about finance and debt ratios, they still have to make things people want to buy.
That's the critical part. You can't just cost-cut your way to growth. And Chris Nelson highlighted a specific product I think illustrates their strategy perfectly. The DeWalt Atomic 20V Max cordless grinder.
Atomic. Sounds intense.
It is, but think about the target audience. Fitters, welders. These are pros who used to use pneumatic, air-powered tools.
Right, with the big hose dragging behind them. And the battery tools just weren't powerful enough.
The battery tech wasn't there. But this new grinder is designed to break that tether, to move these heavy-duty users to cordless.
And it's not just power, it's safety. They have these perform and protect features like anti-rotation.
Anti-rotation, what does that do?
Imagine the grinding wheel gets stuck or pinched. On an old tool, the whole thing kicks back violently at you. This new tech senses that bind instantly and shuts the tool down.
That's huge. That prevents injuries. It keeps your crew working. Precisely. And they mention asset management connectivity too, so you can track where your tool is on the job site with an app.
So you know who borrowed it and didn't bring it back.
Exactly. And this all connects to why they're investing an extra $75 to $100 million in brand activation in 2026
Marketing speak for.
for doubling down on DeWalt, Stanley, and Craftsman. They're launching a whole new suite of Craftsman V20 tools. They believe if they build a better, safer, smarter tool, the pros will pay for it no matter what.
So they're investing in the brand while cutting the back-end costs. Let's look forward then. The 2026 guidance looks optimistic, but there's a big warning sign for Q1.
There is. And we need to clarify this because it's some tricky accounting. They talked about peak tariff expense hitting the P&L in the first quarter.
Okay, help me with the timeline. The tariffs happened in 2025. Why is the expense peaking now?
It's because of inventory accounting. Imagine you buy expensive steel in November 2025. You pay the tariff then. But that steel sits in your warehouse, gets turned into a hammer. You don't recognize that expense on your P&L until you actually sell the hammer.
Ah, I see. So the expensive inventory they bought last year is sitting there like a ticking time bomb.
Exactly. And as they sell through it in Q1, that cost finally hits the books. So Q1 earnings will look suppressed, only 55 to 60 cents per share. They're telling investors right now, do not panic when you see the Q1 numbers.
That's a crucial detail. You'd think the turnaround had failed.
Right,
Yeah.
when really it's just the ghost of 2025 passing through the system. And for the market itself, they're assuming it's going to be roughly flat. They're not betting on a booming economy to save them.
They're betting on gaining market share, taking someone else's slice of the pie with a better grinder.
You have to win the fight on the shelf.
So let's wrap this up. It feels like they're building a fortress around 3 pillars.
I'd call them discipline. That's the price over volume. They had the discipline to charge more and cut $2.1 billion in costs, even when it hurt sales. They chased profitability.
Focus.
That's the portfolio work,
Yeah.
selling aerospace, exiting gas mowers, getting rid of distractions and debt to focus on their core electric tools.
And resilience.
That's the supply chain transformation. They weathered the tariff shock, they're moving out of China, and they're facing a volatile Q1 with a much stronger balance sheet. They're built to withstand a storm.
It's an impressive turnaround, but you know, I keep thinking about that consumer we started with, the weekend warrior.
That's the lingering question, isn't it?
It is. They raised prices and they lost that opening price point customer. They are leaner, profitable, and laser focused on the pro, but with volume down 7%. Here's my final thought. Are they pricing themselves out of the mass market?
It's a huge question about brand loyalty. Is the Craftsman name strong enough to make you pay 15% more when money is tight? Or do you just grab the store brand? If the economy gets worse, they might find they saved the professional market but lost the garage.
That's the gamble. And it's something you, the listener, can check for yourself. Next time you're in the hardware aisle, look at the prices. Are you seeing these hikes? And are you still willing to pay for the yellow and black?
It's the real-world test of their entire strategy.
Thanks for listening to this deep dive into Stanley Black & Decker. We'll catch you on the next one.